Most people think the reason they're not building wealth is that they don't earn enough. The data says otherwise. A 2023 Vanguard study found that the median American household earning $75,000 a year had a net worth of just $47,000 after decades of working. The problem isn't the income, it's the system, or the complete absence of one. Today, I'm giving you the checklist. 9 steps in order with nothing skipped. By the end of this video, you'll know exactly what to do next and why the sequence matters as much as the steps themselves. This is the Day 30 wrap-up for Get Capital Clarity. Over the last month, we've covered a lot of ground. Index funds, Roth IRAs, dollar cost averaging, net worth benchmarks, debt strategy, the 3-account system. Today, we're pulling all of it together into one clean framework. This video is for you if you earn a decent income, you've got money coming in every month, but you're not confident that you're doing the right things with it, or doing them in the right order, because order matters, a lot more than most people realize. We're going to walk through 9 steps. Think of it like a waterfall. You don't move to the next bucket until the current one is full. Skip a step and you leave money on the table, pay unnecessary taxes, or carry expensive debt while your brokerage account sits at 0. Follow the order and your money starts working the way it's supposed to. No fluff, no theory, just the checklist. Let's go. Chapter 1. Why your emergency fund has to come first. Step 1 is not investing. That surprises people. It is building a starter emergency fund. The target is $1,000 to $2,000, liquid, accessible, sitting in a high-yield savings account. Right now, a competitive HYSA is paying around 4 to 5% APY. Institutions like Marcus by Goldman Sachs, Ally, and SoFi all offer accounts in that range. Your money isn't just sitting there idle, it's earning while it waits. Here's why this step comes first. Without a buffer, any unplanned expense, a car repair, a medical bill, a job gap, forces you onto a credit card. The average credit card interest rate right now is over 22%. One $800 repair can cost you hundreds of dollars in interest and wipe out weeks of disciplined investing. You cannot build wealth while bleeding interest. So before you touch your 401k beyond the employer match, before you open a Roth IRA, before you do anything, you need $1,000 to $2,000 in a HYSA that you do not touch unless it's a real emergency. Here's a stat worth sitting with. According to the Federal Reserve's 2023 report on the economic well-being of U.S. households, 37% of Americans said they could not cover a $400 emergency with cash, not a $4,000 emergency, not a $40,000 emergency, $400. If that number hits close to home, this step is your entire financial priority until it's done. Chapter 2. The 401k match is not optional. Step 2 is capturing every dollar of your employer's 401k match. If your employer matches 4% of your salary and you contribute at least 4%, you receive an immediate 100% return on that portion of your money, before a single investment grows a single dollar. There is no other financial product on earth that gives you that return on day one. Not investing enough to capture the full match is the equivalent of turning down part of your salary. It's compensation your employer has already set aside for you. Declining it doesn't save the company money. It just costs you yours. How to do it? Log into your HR portal or call your benefits line. Find the match structure. Confirm your contribution rate meets or exceeds the threshold. Fidelity, Vanguard, and Empower all manage the majority of employer 401k plans in the U.S. The interface is different, but the logic is the same. Find the match, hit the threshold, move to step 3. One clarification before we go further. This step is only about hitting the match threshold. We're not maxing the 401k yet. That comes later. Right now, we want the free money and nothing more. Chapter 3. High-interest debt, then tax-advantaged accounts. Steps 3 through 6 happen in sequence, and this is where most people get the order wrong. After capturing the employer match, your next move is eliminating high-interest debt. I define high interest as anything above 6 to 7% APR. Credit cards, personal loans, store financing, medical debt, and collections. The math is simple. If debt costs you 22% and your investments return an average of 8 to 10% per year, you're net negative. Paying that debt off is the highest guaranteed return available to you. Student loans and auto loans in the 3 to 5% range. Those are low priority. You'll likely out-earn that rate by investing. Don't accelerate them while ignoring better uses of capital. Once high-interest debt is gone, you move to step 4, max your Roth IRA. The 2026 contribution limit is $7,500 per year, or $8,500 if you're 50 or older. The Roth IRA is one of the most powerful wealth-building tools in the tax code. You contribute after-tax dollars. The money grows tax-free. You withdraw it in retirement without owing a single dollar to the IRS. Fidelity, Vanguard, and Schwab all offer Roth IRA accounts with no minimums on broad market index funds. Inside that account, VTSAX, FXAIX, and VOO are the most common holdings among people in this income range. Simple, diversified, and low cost. If your income exceeds the Roth IRA threshold, $153,000 for single filers in 2026, $242,000 for married filing jointly, you can still access this benefit through what's called the backdoor Roth conversion. We've covered that in a separate video. Step 5. Now you go back and max your 401k. The 2026 employee contribution limit is $24,500, or $32,500 if you're 50 or older. This is where the real tax advantage compounding happens. Money goes in pre-tax. It lowers your taxable income today. It grows for decades. You pay taxes on the way out in retirement, typically at a lower rate than your current bracket. If your employer offers a Roth 401k option, the decision between pre-tax and Roth contributions depends on whether you expect your tax rate to be higher or lower in retirement. Generally speaking, if you're early career or expecting income growth, lean Roth. If you're at peak earning years now, lean traditional pre-tax. Step 6. If you have a high deductible health plan through your employer, open and max an HSA. The HSA is the only account in the U.S. tax code with a triple tax advantage. Contributions reduce your taxable income. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free. And after age 65, you can withdraw for any reason and just pay ordinary income tax, same as a traditional 401k. It is, by every objective measure, the best tax-advantaged account most people aren't using. The 2024 contribution limit is $4,150 for individuals and $8,300 for families. Chapter 4. After the tax advantages are maxed. Once you've done steps 1 through 6, you have an emergency cushion, no high-interest debt, your full employer match, a maxed Roth IRA, a maxed 401k, and, if eligible, a funded HSA. That is the foundation. Everything from here is building on top of it. Step 7. Complete your emergency fund. Earlier, you built a starter fund of $1,000 to $2,000. Now you bring it up to a full 3 to 6 months of living expenses. Why wait until now? Because during steps 2 through 6, you had better uses for that money. A 22% interest rate and uncaptured employer match both beat the 4.5% your HYSA is earning. But once those are handled, a full emergency fund becomes your highest return use of the next available cash. 3 months if your income is stable and predictable. 6 months if you're self-employed, in a commission-based role, or working in a volatile industry. Step 8. Taxable brokerage account. A taxable brokerage account is just a standard investment account with no contribution limits and no tax advantages. You can open one at Fidelity, Vanguard, or Schwab in about 10 minutes. Money goes in after tax, grows with the market, and gets taxed on capital gains when you sell. The reason this comes after all the tax-advantaged accounts is obvious. You want every dollar of tax benefit available to you before you put money into an account with no shelter. Inside a taxable account, the strategy is essentially the same. Low-cost, broad market index funds, VOO or VTSAX for U.S. and global exposure. Hold long-term. Let compounding work. Step 9. Build the full emergency fund and let time do the rest. At this point, your financial machine is running. You've eliminated the leaks. You've maximized the tax advantages. You're invested in the market at a cost structure that won't eat your returns. The only variables left that matter are time, contribution rate, and avoiding the behavioral mistakes. Panic selling in downturns, chasing individual stocks, stopping contributions when the market drops. Here's the complete checklist in 60 seconds. 1. Starter emergency fund, $1,000 to $2,000 in a HYSA. 2. 401k contributions up to the employer match, not a dollar less. 3. Pay off all high-interest debt above 6 to 7% APR. 4. Max your Roth IRA, $7,500 in 2026. 5. Max your 401k, $24,500 in 2026. 6. Fund your HSA if you're eligible, $4,150 individual, $8,300 family. 7. Complete your emergency fund to 3 to 6 months of expenses. 8. Open a taxable brokerage account and invest the remainder. 9 is not a step. 9 is what happens when you followed all 8. You let compounding do the work that you can't. The reason most people in their 30s and 40s feel behind isn't income, it's sequence. They invest out of order, skip steps, and wonder why their net worth doesn't reflect what they earn. Now you have the sequence. Here's your action step for today. Not tomorrow, today. Pull up your HR portal or your benefits dashboard and confirm 2 things: your current 401k contribution rate and whether it meets the employer match threshold. That's it. 10 minutes. That single check might be worth thousands of dollars a year in free matching contributions you're currently leaving on the table. Now I want to hear from you. Drop a comment and tell me, where are you right now in this sequence? Are you on step 1 or step 7? No judgment, just your honest number. It helps me make better content, and it might help someone reading your comment figure out they're not as far behind as they think. If this video was useful, subscribe. We post every week on investing, net worth benchmarks, and the money systems that actually work. And if you want the full investing order of operations as an interactive guide you can work through at your own pace, the link is below. It walks you through every step in detail with action items and real numbers, completely free. I'll see you in the next one.